Imagine this scenario, right? You're at the track, you place just a massive bet on a horse, and you watch that horse completely obliterate the competition. I mean, it crosses the finish line first, breaks the track record. The crowd is going wild.
Yeah, you're feeling pretty good about it.
Exactly, you're thrilled. So you walk up to the betting window, slap your ticket on the counter, fully expecting a massive windfall, and the cashier just looks at you, slides the ticket back, and says, actually, you owe us money.
Right. It sounds totally absurd when you frame it like that. I mean, nobody would play that game. But in the world of options trading, specifically around corporate earnings reports, that exact scenario plays out, every single quarter.
It really does. Think about the last time you bought a call option right before a highly anticipated earnings report. You did the research, you read the tea leaves, you wake up at like 6:30 a.m., check your phone in the dark, and you see the stock is up 10% in the pre-market.
You were dead right.
You were dead right, but then the opening bell rings, the options chain updates, and your portfolio is suddenly just bleeding out. You're down 80% on a trade where you correctly predicted the direction of the underlying stock. It's probably the most uniquely infuriating experience in the financial market.
Oh, absolutely. And the immediate reaction is always to blame the market, right? To assume it's rigged or that the system is just completely broken.
Yeah.
But the hard truth, and this is tough for a lot of people to hear, the market mechanics are functioning perfectly.
The system isn't broken.
Right. The system isn't broken. You are just playing a game where you don't fully understand the physics engine running underneath it. When you buy options ahead of earnings, you are stepping into a brutal, highly structured ecosystem. We're talking institutional liquidity traps, volatility modeling, predatory bid-ask spreads.
And that is exactly our mission for this deep dive. We are taking a stack of incredibly detailed postmortems of real options trades on tech giants. Companies like, Palo Alto Networks, Dell, Hewlett-Packard Enterprise, Snowflake, Datadog.
The heavy hitters.
Yeah. And we're going to deconstruct the exact mechanics of why retail traders get slaughtered even when they are right. And on the flip side, how the quantitative desks at major institutions actually operate. We want to move you from that emotional gambling mindset into the cold, systematic framework used by the pros.
Including a highly specific 5-factor predictive model, which we'll get into.
I will. But before we can start building a robust institutional-grade strategy, we have to clear the rubble. We have to look at a spectacular failure to understand how the market violently punishes expectations that look perfect on the surface.
Yeah, which brings us to our first major case study, the Palo Alto Networks, or PAN-W autopsy.
Right, and if you just looked at the headline numbers for this specific quarter, it looked like an absolute slam dunk.
On the surface, yeah. The algorithms and the financial news networks, they saw exactly what they wanted to see. PAN-W delivered a textbook double beat. I mean, Q3 revenue came in at $3 billion, which was a 31% year-over-year increase.
Easily clearing Wall Street estimates.
Exactly. And adjusted earnings per share hit 85 cents, beating the 80-cent consensus.
And the forward-looking metrics were massive, too. Their next-gen security annual recurring revenue, their ARR, was up 60%. Remaining performance obligations hit $18.4 billion. That's a 36% jump.
A massive backlog.
Yeah, and to cap it all off, management actually raised their forward guidance. I mean, that is the holy grail. The initial algorithmic reaction in the after-hours session sent the stock spiking 10%.
But by the time the dust settled the next day, the stock had plummeted.
It completely collapsed.
It did. And this happens because, well, the trading bots read the top-line headlines in milliseconds. But institutional analysts, they take hours to read the footnotes.
Yeah.
And underneath those glowing headlines, there were 3 fatal flaws.
Okay, let's break those down. What was the first one?
The first flaw was valuation gravity. PAN-W was already priced for absolute perfection.
Because in the month of May alone, leading directly into this earnings print, the stock had surged roughly 65%.
Right. And when a stock runs up 65% in 4 weeks, you are no longer trading the company's fundamentals. You're trading pure momentum, pure euphoria. The stock hit an RSI, a relative strength index, of 83.71.
And for context, an RSI over 70 is traditionally considered heavily overbought, right?
Exactly. And its forward price to earnings ratio had expanded to 83. When you're trading at 83 times forward earnings, a 31% revenue jump isn't a massive triumph. It's literally the bare minimum requirement just to prevent a catastrophic repricing.
Okay, let's unpack this with an analogy because I think this is crucial. It's like the market isn't grading on a standard curve. If a student who usually gets a C suddenly gets an A, the parents are thrilled, the market cheers. the stock goes to the moon.
Right, because it's an unexpected beat.
But Pan W was the straight A valedictorian. Everyone already expects straight A's. So when the valedictorian brings home a report card that looks like an A on top but has a few hidden demerits in the notes, the parents, or in this case the market, they are furious. They pull the scholarship.
That is a perfect way to look at it. And that leads directly to the second flaw, which were those hidden demerits, specifically the reality of GAAP versus non-GAAP earnings.
Right.
The headlines touted the adjusted non-GAAP profitability. But under strict GAAP accounting rules, Pan W actually posted a $177 million net loss for the quarter.
Wait, a loss. $177 million net loss compared to a $262 million net profit in the exact same quarter the previous year. Where is that massive discrepancy coming from?
Two main culprits that institutions just despise. First, aggressive inorganic growth. They bought companies like CyberArk and Chronosphere, which generated $198 million in immediate acquisition-related costs.
Okay, but acquisitions happen. What was the bigger issue?
Stock-based compensation, or SBC, they handed out a staggering $517 million in shares to their employees in a single quarter.
$500 million. Wow.
Yeah, over $500 million in shareholder dilution just papered over in the adjusted numbers. And institutional investors modeling future discounted cash flows, they despise aggressive SBC because it artificially inflates operating cash flow in the short term, but it permanently dilutes the equity base.
So when the human analysts woke up the next morning and actually ran the real numbers, they realized the margin growth was severely lagging the revenue growth.
The quality of the earnings was fundamentally hollow.
Right. And then you couple that fundamental issue with the technical reality. The stock was ramming right into the $300 psychological resistance level, and importantly, insiders were actively dumping shares.
Yes. Executive vice presidents were selling heavily into that pre-earnings run-up. The insiders were literally using the retail pre-earnings FOMO as an exit liquidity pool.
Wow.
So you have extreme overvaluation, massive dilution, psychological resistance, and insiders cashing out. That initial 10% after-hours spike was just the final algorithmic gasp before the institutional hammer dropped and the stock cratered.
Now, that cratering is painful for equity holders, sure, but for a specific class of retail options trader, this wasn't just a 15% portfolio hit, it was a 100% wipeout.
A total zero.
Let's dig into a specific trade from this Pan W scenario because it perfectly illustrates the mechanics of the options pricing trap. A trader bought a deep out-of-the-money call option, a $350 strike expiring in mid-July. They bought this when the stock was trading right around $300, just days before the report.
Yeah, and the outcome of that trade is what quantitative desks refer to as a double kill. The trader got the directional bet wrong, obviously, because the stock ultimately fell. But what actually destroyed the portfolio was the collapse of implied volatility, for crush.
We need to spend some real time on IV Crush because it is the silent killer. It wipes out more retail accounts than anything else during earnings season. How does the pricing model actually work here?
To understand IB Crush, you have to look at how market makers price options. An options price is composed of intrinsic value, which is real mathematical value based on where the stock is currently trading relative to your strike, and extrinsic value.
Extrinsic value being basically the price of time and volatility, right?
Exactly. Implied volatility is the market's expectation of how violently a stock is going to swing in the future. Right before an earnings report, uncertainty is at its absolute peak. Nobody knows if the stock is going up 20% or down 20%.
Right.
And because of that extreme uncertainty, the market makers who are selling you those options, they demand a massive premium to take on that risk. They artificially inflate the implied volatility metric in the Black-Scholes pricing model. This pumps massive amounts of extrinsic value into the option. You are paying a huge event risk premium just to hold the contract.
But the critical mechanism is what happens the very second the earnings press release hits the wire. The uncertainty doesn't slowly fade over a few days. It vanishes instantly.
The event horizon has been crossed. Good, bad, indifferent, the unknown has become the known. And because the uncertainty is gone, the market makers instantly rip that volatility premium right back out of the options chain. The IV collapses.
So even if the stock goes exactly where you thought it would, if it doesn't move fast enough or far enough to replace that lost IV with real intrinsic value, your options price still implodes.
Let's visualize this. Let's contrast that doomed $350 call with a hypothetical $310 call bought at the exact same time. The stock is at $300. When Pan W temporarily spiked to $320 in the after-hours session, why would the $310 call have survived the IV crush while the $350 call was still destined for death.
Well, because the $310 call actually crossed the finish line. When the stock hits $320, the $310 call instantly goes in the money. It suddenly possesses $10 of undeniable mathematical intrinsic value.
And more importantly, it's delta surges. Delta measures how much the option's price changes for every $1 move in the underlying stock. As an option goes deep in the money, its delta approaches 1.0.
Meaning it begins to act almost exactly like holding 100 shares of the stock itself.
Right. High delta acts as a defensive shield against IV crush. The option's value is now rooted in the reality of the stock price, not just the speculative hope of future volatility.
But that $350 call, even when the stock spiked to $320, it was still $30 away from the strike price.
It remained deeply out of the money. It possessed zero intrinsic value. Its entire price tag was composed of that inflated extrinsic hope value. So when the market opened the next day, the stock fell back down to $300 and the IV collapsed.
And the $350 call lost its volatility premium and gained zero intrinsic value to offset it.
It became worthless paper overnight. Buying naked, far out of the money options right before an earnings report isn't trading. It's buying a lottery ticket where the house takes a 50% cut the moment the numbers are drawn.
Knowing the math is fantastic for planning the next trade. But let's get deeply pragmatic here. What happens when you are currently caught in the bear trap? You're the trader holding that doomed $350 Pan W call. You wake up, the opening bell rings, you're down 75%, and you're staring at a massive red number on your screen.
The first step of triage is mastering your own psychology. And that translates into a very strict mechanical rule. Do not panic sell in the first hour of the market open.
That runs counter to every human instinct. If my position is bleeding out, my brain is screaming at me to hit the sell button immediately just to stop the pain. Why do I hold on?
Because the first 60 minutes after a confusing or counterintuitive earnings report is an environment of total structural chaos. Retail traders are panicking, algorithms are violently rebalancing, and the market makers know exactly how vulnerable you are.
Price discovery is broken.
Completely broken. So to protect themselves from the volatility, market makers drastically widen the bid-ask spreads. If you hit sell at market at 9:35 a.m., you aren't just taking the fundamental loss on the trade, you are paying a massive predatory liquidity tax to the market maker just to execute the order. You are guaranteeing your fill price will be at the absolute bottom of the emotional trough.
So you just have to sit on your hands and wait for the spread to tighten up. And while you are sitting there, what is the other major psychological trap to avoid?
Do not, under any circumstances, try to average down on a deep out-of-the-money option.
The martingale strategy. The idea that, hey, if I bought the contract for $5 and now it's worth $1, I should buy 4 more contracts to bring my average cost way down. That way, I only need a tiny bounce to break even.
It is throwing good money into a burning furnace. With deep out-of-the-money options, your primary enemy is time decay. By averaging down, you are simply increasing the amount of capital that is actively depreciating. You're doubling your exposure to a thesis that the market has already aggressively rejected.
So we wait out the morning chaos, and we refuse to average down. Our trader has a $350 call with roughly 45 days to expiration, or DTE. How do they actually rescue whatever capital is left?
Having 45 days is the only reason this trader has viable lifelines. The most basic rescue plan is waiting for technical algorithmic support. Even when a great company gets punished for valuation, the underlying business is still generating cash. Usually over the next 5 to 10 trading days, the stock will bleed down until it hits a major technical moving average like the 50-day or the 100-day.
And when it hits that invisible line on the chart, the quantitative funds that were waiting on the sidelines suddenly view the stock as cheap, and their buy algorithms kick in,
generating a mechanical 2% to 4% bounce. As the stock bounces, the gamma on your option briefly inflates the price. That is your exit window. You use that technical mechanical bounce to salvage a portion of your initial premium. It's still a loss, but it's a managed loss.
But there is a much more structural maneuver available, right? Converting the naked call into a spread.
This is the professional triage method. You're bleeding because you own the $350 call. So you go into the options chain and you sell to open a higher strike call with the exact same expiration date. You might sell the $370 call.
By selling that $370 call, I am immediately collecting cash premium from whoever bought it. That cash instantly hits my account and directly offsets the massive unrealized loss on my $350 call.
You are structurally lowering your cost basis in real time. Now, if the stock stays below $370, which is highly likely given the post-earnings crash, the option you sold simply expires worthless. You get to keep that premium free and clear, acting as a direct subsidy for your original mistake.
The obvious trade-off is that I'm hard capping my upside. If PanW announces tomorrow they are being bought out by Microsoft for $400 a share, my gains are completely capped at $370.
Sure, but when you are in the triage phase, you have to abandon the fantasy of the yacht. You're just trying to stop the arterial bleeding. Capping a statistically improbable upside to guarantee real cash today is how you survive to trade another quarter.
Right.
And if you still genuinely believe the stock is going to rally, but you admit your strike price was absurd, you execute the third option. You roll the position. You take the loss on the $350 call, extract the remaining capital, and use it to buy a much more realistic strike, like a $310 call, potentially further out in time. You retreat, regroup, and deploy your capital into a battle you can actually win.
Now, I want to push back on the timeline here because there is a very dangerous piece of conventional wisdom floating around retail trading forums. A lot of traders believe that because of the way the Black-Scholes model calculates theta, the rate of time decay, you are perfectly safe holding a losing option until exactly 21 days to expiration.
Oh, I've seen that.
Right. The math supposedly shows that the decay curve is relatively flat until 21 DTE, and then it falls off a cliff. So why wouldn't our trader just hold on and pray for a miracle rally until day 21?
Because applying that specific Black-Scholes theta curve to a deep out-of-the-money option is a fundamental misreading of market microstructure. That 21 DTE rule is modeled for at-the-money options. When you are holding a deep out-of-the-money option that has moved against you, waiting until 21 days is financial suicide. You run headfirst into delta death and the liquidity black hole.
Walk me through delta death first.
As the clock ticks down toward 21 days, if the stock is still languishing at $300, the mathematical probability of it ever reaching your $350 strike approaches absolute zero. Because the probability is zero, the option's delta crushes down to 0.05 or lower.
The option loses all elasticity.
Exactly. If the stock suddenly surges $10 in a single afternoon, your option might only gain 2 or 3 pennies. A miracle rally cannot save you because the option is functionally paralyzed. It's completely disconnected from the underlying stock's movement.
And what happens with the liquidity at that stage?
Institutional algorithms and market makers constantly monitor their inventory risk. When an out-of-the-money option enters that 30-day window, the big players recognize it as dead paper. They abandon the strike entirely. The volume dries up to zero.
And when that happens, the bid-ask spread just widens into a chasm.
Yes. The asking price on your screen might say 15 cents, but the actual bid, what a market maker is actually willing to pay you to take it off your hands, might be 1 single penny. Even if you want to sell it, you physically can't. The liquidity has evaporated. The hard rule for triage is that you must exit a losing out-of-the-money position by 30 DTE. Waiting until 21 DTE means you are trapped in a burning building with no exits.
That makes perfect sense. Now, this entire triage process heavily relies on the concept of spreads, specifically, selling a call against a long call to mitigate risk. But I want to pause here because this mechanism gets frequently confused with another incredibly popular retail strategy.
The poor man's covered call.
Exactly, the PMCC. They both involve buying one call and selling another, but structurally they are entirely different animals.
They share a superficial similarity in that they are both debit spreads designed to reduce cost. But their risk profiles, their timelines, and their fundamental purposes are completely distinct.
Let's break down the standard bull call spread first, which is what we used in the triage example.
A standard bull call spread is a purely directional, short-term, closed-loop system. You buy a call at a specific strike, say $310, and you simultaneously sell a call at a higher strike, say $330. The critical factor is that both of these options share the exact same expiration date.
You're making a highly specific bet that the stock will move between point A and point B within a strictly defined time window.
Right. Your maximum loss is capped at the debit you paid, and your maximum profit is hard capped at the difference between the strikes. Once expiration day arrives, the trade resolves entirely. It's over.
But a PMCC is a cross-calendar strategy. It's an ongoing structural position.
Exactly. With the PMCC, you're trying to replicate the cash flow benefits of owning 100 shares of the actual stock, but using massive leverage to do it for a fraction of the capital. The foundation of the PMCC is the long leg, which is a LEPS option, long-term equity anticipation securities. You buy a call option that expires a year or even 2 years out in the future.
And the most important metric here is that the LEPS must be deep in the money, with a delta greater than 0.8. Why is that specific delta so critical?
Because a delta of 0.8 or 0.9 means the option is virtually entirely composed of intrinsic value. It has almost no extrinsic bubble premium to be eaten away by time decay. For every dollar the stock moves, your APS option moves 80 or 90 cents. It tracks the underlying equity so closely that it acts as a synthetic stock replacement. You now control the rights to 100 shares for a year or more.
So once I own that synthetic stock, how do I generate the yield?
You act as a landlord. Because your lead piece gives you the right to buy the stock, your broker allows you to legally sell short-term out of the money calls against it. You might sell a call that expires in 7 or 14 days. You collect the premium from the buyer of that short call. As long as the stock doesn't violently spike past your short strike, that option expires worthless. You keep the cash premium, and on Monday morning you sell another one.
Here's where it gets really interesting based on the analogy from the text. A standard call spread is like betting on a short sprint race. It's one and done. You win or you lose, and then you go home. A PMCC is like taking out a mortgage on a house. The leap house option is the house. You put down a capital down payment to control the asset for the next 2 years. The time decay on that leap house is like your property taxes, a slow, manageable burn.
Right.
To pay off the mortgage and the taxes, you rent out the rooms on Airbnb every single weekend. That weekly rental income is the premium you collect from selling the short-term calls. You systematically use the short-term income to finance the long-term asset.
It's an elegant structural strategy, but both the call spread and the PMCC share one devastating vulnerability, which often catches traders completely off guard. They both experience maximum pain if the underlying stock experiences a massive, unexpected melt-up.
Right. If the stock announces game-changing news and goes absolutely parabolic, your upside is strictly capped by that short call you sold. You have to sit there and watch the stock run up 40%, knowing you are legally obligated to hand over your synthetic shares at a massive discount to the current market value. You capped your own gains.
It induces a terrible feeling of missing out. But as we just learned from the Pan-W autopsy, sacrificing unlimited upside to gain structural protection against ID crush, time decay, and downside risk is the defining characteristic of a professional trader. Uncapped upside is a lottery ticket. Capped, defined risk is a business model.
Okay, so we understand that naked OTM calls are a gamble, and spreads offer us the structural fortress we need. But the fortress is useless if we build it on the wrong plot of land. How do we actually pick the right stocks before earnings? How do we avoid the value traps and find the companies poised for massive upward repricing? We need to follow the smart money.
This is where we completely abandon retail guesswork and step into the world of institutional order flow. Why did stocks like Dell and Hewlett-Packard Enterprise gap up 30% while others collapsed? It wasn't luck. It was entirely predictable if you knew how to read the footprints of smart money.
Let's define smart money here. We aren't just talking about a guy with a large Robinhood account.
No, we are talking about quantitative hedge funds, pension funds, and major asset managers. These entities do not wait for the 4:00 p.m. press release to find out if a company had a good quarter. They utilize massive alternative data networks. They're tracking global shipping manifests in real time, scraping credit card transaction data, analyzing satellite imagery of retail parking lots, and conducting deep supply chain channel checks in Asia.
They already know.
They have modeled the earnings report with a high degree of confidence weeks before it is published.
And because they are managing billions of dollars, they have a massive liquidity problem. They can't just buy their full allocation in the after-hour session when the news breaks. The volume isn't there to absorb their orders without blowing up the price.
Exactly. If a fund needs to accumulate $500 million of Dell stock, they have to do it quietly over the weeks leading up to the report. But despite their best efforts to hide their buying through dark pools and algorithmic execution, money that large always leaves footprints in the options market.
And those footprints form the basis of the 5-factor quantitative model designed to predict PEAD, or post-earnings announcement drift. Let's break down these 5 factors meticulously. Factor number 1, sector focus and the absolute necessity of a guidance raise.
Context matters. Right now, the market is aggressively rewarding the AI infrastructure sector. But simply having a great quarter isn't enough. Institutional valuation models, specifically discounted cash flow models, are entirely forward-looking. A massive beat on past earnings is already priced into the current stock value. What alters the fundamental valuation of a company is the forward guidance.
Meaning the CEO has to officially step up to the microphone and tell Wall Street analysts that the next 12 months are going to be significantly more profitable than anyone currently believes.
If an AI company absolutely crushes their current earnings, but they leave their future guidance flat, institutional models view that as a massive deceleration of growth. For a high multiple tech stock, Growth deceleration is an immediate sell signal. The foundational requirement for a massive gap up is the beat and raise. The future must look brighter than the past.
Factor 2 is a high SUE, which stands for standardized, unanticipated earnings. Why isn't a normal earnings beat good enough?
Standardized unanticipated earnings measures the sheer shock value of the report. It analyzes how far the actual earnings deviated from the consensus estimates, measured in standard deviations. If a company beats estimates by 2 cents, that's a beat, but it falls well within the normal margin of error of an analyst's spreadsheet. It doesn't force the analyst to change their underlying assumptions.
It's business as usual.
Right. But a high SUE, a beat of 2 or 3 standard deviations, shatters the existing models. It forces every institutional analyst to completely tear up their spreadsheets overnight and aggressively upgrade their price targets the next morning. That forced recalibration is what drives the buying frenzy.
That brings us to factor 3, which is the most mechanically complex part of the model, institutional options sweeps. We're looking for massive options block trades leading into the earnings date, and there are 3 specific criteria we need to see. First, the daily volume of the options traded must be significantly greater than the existing open interest. Why is that comparison important?
Open interest represents the total number of active, outstanding contracts that exist in the market. Volume is simply how many contracts changed hands today. If you see massive volume, but it's smaller than the open interest, it might just be institutions shuffling their existing hedges around or closing out old positions. But if the daily volume violently exceeds the total open interest, it tells you definitively that massive brand new risk is being aggressively opened. Smart money is placing entirely new, massive bets right before the binary event.
The second criteria is that the delta-weighted volume must be 3 times the historical average.
Smart money doesn't buy lottery tickets. When you see retail FOMO, you see huge volume and cheap, deep, out-of-the-money calls with a delta of 0.10. That is just noise. Institutions buy at-the-money or deep-in-the-money calls with a high delta of 0.60 or 0.80. These contracts are wildly expensive. When you see triple the normal volume heavily weighted toward high-delta contracts, it means institutions are committing serious directional capital. They're using options as a leverage surrogate for buying the stock itself.
And the final, most crucial criteria for these sweeps. The trades must be executing on the ASK price. Let's dig into the market microstructure here. Why is hitting the ASK the ultimate smoking gun?
In any order book, you have the bid, which is the highest price a buyer is passively offering to pay, and the ask, which is the lowest price a seller is demanding. Normally, large institutions execute algorithmic orders designed to passively capture the bid, saving them pennies on millions of shares. It is a slow, methodical process.
So if a massive block trade executes precisely on the ask price or even sweeps across multiple exchanges to buy above the ask?
It reveals absolute desperation. It means the institutional buyer has told their algorithm, I don't care about saving a few pennies and I don't care about hiding my footprint. Buy every single contract available at whatever price the market makers are demanding right now. When smart money abandons price sensitivity, it means their alternative data is screaming that a massive upside move is imminent. It is pure, unadulterated institutional FOMO.
Wow. Okay, factor 4 is IV skew, specifically looking for a severe right skew in the options chain.
Historically, options chains exhibit a left skew, commonly known as a volatility smirk. Put options, which protect a portfolio against a crash, are structurally more expensive than call options. Institutional managers gladly pay a premium for fear and insurance. But on rare occasions, right before a massive breakout, that skew violently flips to the right. The implied volatility on the call side surges past the put side.
Meaning traders are suddenly willing to pay a massive premium for greed rather than fear.
Exactly. The demand for upside exposure becomes so intense that market makers are forced to rapidly hike the price of calls just to manage their own risk. A severe right skew means the smartest players in the market are aggressively positioning for a gap up.
And finally, factor 5, insider buying. But there's a massive caveat here regarding SEC filings.
You have to ignore routine insider selling. Tech executives are compensated largely in stock. They use automated pre-scheduled 10b5-1 plans to mechanically sell shares every month to pay their taxes or buy real estate. That selling is completely disconnected from their view of the company's future. What we are hunting for are Form 4 filings showing open market buying.
Real money.
Yes. When a CEO or a chief financial officer reaches into their own personal bank account and actively purchases millions of dollars of their own company's stock on the open market right before the quiet period begins, that signal overrides everything else. No algorithm on Earth knows the upcoming quarter better than the people who wrote the report.
So you run the five-factor model. You find a stock that checks every single box. High SUE, guidance raise, sweeping on the ask, right skew, insiders buying. But what if the macro environment falls apart on the exact day of earnings? What if the Federal Reserve unexpectedly signals a rate hike, inflation data comes in incredibly hot, and the NASDAQ composite drops 2% across the board? Doesn't a terrible macro environment crush even the best micro setup?
That's a highly sophisticated concern, but it actually provides us with one of the most powerful secondary confirmations in all of trading: the concept of relative strength. Imagine a river flowing heavily downstream that's the macro market selling off. Most stocks are just sticks in the river. They get swept away and drop 2% or 3%. But if the NASDAQ is down 2% in a panic, and the specific stock you modeled is completely flat, or maybe even ticking up 0.1%,
It's a boulder in the river.
precisely, it means the institutional buying pressure quietly accumulating underneath that specific stock is so immensely powerful that it is absorbing an entire market-wide algorithmic sell-off without giving up an inch of ground. It is defying gravity. When that macro pressure eventually lifts and the market stabilizes, that stock is going to explode upward like a coiled spring. Relative strength during a macro downturn is the ultimate confirmation that your five-factor model is correct.
Okay, so the setup is perfect. You identified Hewlett-Packard Enterprise, HPE. You observed the relative strength. You responsibly utilized a call spread to cap your risk and protect against IV crush. The earnings report drops, and it is a masterpiece. They announce a massive AI server backlog, they raise guidance, and the stock goes completely parabolic. It gaps up from the low 40s all the way to $56 a share. You won the game.
You executed the institutional playbook perfectly.
But winning too hard in the options market introduces a deeply frustrating structural nightmare. Let's dissect Section 6, the happy problem, deep ITM liquidity traps. Let's look at the exact numbers from the HPE case study.
Our trader entered a bull call spread. They bought the $44 call and sold the $55 call. The maximum theoretical value of this spread is simply the difference between the two strike prices. 55 minus 44 equals 11. The spread is mathematically capped at a maximum value of $11 or $1,100 per contract.
The stock rockets to $56. Both the $44 long call and the $50 general short call are now firmly in the money. The stock is blown past the finish line. The trader logs into their brokerage account, thrilled, ready to lock in that $11 max profit. But when they look at the bid-ask spread on their screen, the market isn't offering them $11. It's not even offering $10. The highest bid available to close the trade is $7.
Welcome to the deep in the money liquidity hole. It is one of the most infuriating experiences for a developing trader.
So what does this all mean? I won the game, but the casino won't let me cash in my chips. Mechanically, why is this happening? I got the direction right, I got the magnitude right, the stock is above my short strike.
It comes down to the mechanics of the order book and the total evaporation of retail participation. Think about where the volume is trading now. The stock is at $56. All the retail day traders and institutional algorithms are frantically trading the $56, $58, and $60 strike options. The volume is massive there. But your strikes, the $44 and the $55, have been left in the dust. They are so deep in the money that retail traders can't afford them, and institutions have no reason to trade them. The natural volume drops to zero.
So who is left on the other side of the screen?
Only the automated market makers. They are legally obligated to provide a quote to ensure the market functions, but they are under no obligation to give you a fair price. Because there are no other buyers competing with them, they widen the bid-ask spread to predatory levels to protect themselves from inventory risk.
To exit the trade, I have to sell my $44 call, which is great, but I also have to buy back this $55 call that I originally sold.
Exactly. And the market maker inflates the asking price on that $55 call. They use complex pricing models to claim that because there is still time left until expiration, that $55 call still possesses significant time premium and residual volatility premium. So you are forced to pay an artificially high inflated price just to buy back your short leg. That inflated cost directly eats into the intrinsic profit of your long leg. The fundamental math says your spread is worth $11, but the market maker's extortionate bid is only $7.
That is just maddening. But wait, I've seen advanced traders talk about a structural cheat code to bypass the options market maker entirely in this exact scenario. If the options market won't give me fair value, but the underlying stock is trading at $56, why not just go into the equity market and short 1,000 shares of the stock at $56? Doesn't that instantly lock in my profit and completely bypass the option spread extortion?
I am incredibly glad you brought this up, because we need to issue a massive blinking red alert right here. What you are describing is a real institutional technique known as delta hedging. But if you apply that technique to a spread rather than a naked call, it is absolute financial suicide. It will destroy your account.
Okay, let's slow down and unpack this thoroughly. I love a good cheat code. Why does shorting the stock work brilliantly for a naked call but blow up a spread?
It all comes down to understanding the mechanics of delta neutrality. Let's pretend for a moment that instead of a spread, you just own naked $44 calls and the stock surged to $56. Because your calls are $12 deep in the money, their delta has essentially reached plus 1.0. For every single dollar the stock goes up, your calls gain exactly $1. For every dollar it drops, they lose $1.
They are acting as a perfect synthetic equivalent to owning 100 shares of the actual stock.
Precisely. Now, if you go into the market and short 100 shares of the actual equity at $56, the delta of a short stock position is exactly negative 1.0. You now possess a plus 1.0 delta from your naked options and a negative 1.0 delta from your short stock. When you combine them, your net portfolio delta is exactly zero. You are perfectly flawlessly hedged.
So if the stock crashes back down to $40, my options lose a fortune, but my short stock makes a fortune, perfectly offsetting the loss. And if the stock rockets to $100, my options make a fortune, perfectly offsetting the massive loss on the short stock. I have artificially frozen time, I've locked in the profit exactly at $56, and I can just hold both positions until expiration Friday and let the clearinghouse net them out for zero fees.
That is exactly how market makers lock in arbitrage. It is a beautiful mechanism. But you cannot do that with a call spread because its spread's delta profile is radically different.
Why? I still own the $44 call.
Yes, but you sold the $55 call. Look at the delta curve of the spread. As the stock moves from $44 toward $55, the spread's net delta is positive. But the absolute second the stock price crosses above your short strike of $55, the plus 1.0 delta of your long call is completely neutralized by the negative 1.0 delta of the short call you sold.
Because my gains are mathematically capped, the spread literally cannot gain or lose any more intrinsic value above $55.
Exactly. The spread's net delta drops to zero. Your options position is already fully internally hedged. So imagine the catastrophe if you try to execute the cheat code. You hold a fully capped spread and you decide to short 1,000 shares of HPE stock at $56 to lock it in.
Okay, my spread maxes out at $1,100 and I short the stock.
The next morning, HPE announces a surprise exclusive partnership with NVIDIA to build next-generation AI supercomputers. The stock goes absolutely ballistic and opens at $70 a share.
Oh no.
Let's do the math. Your 4,455 call spread is still worth exactly $11. It didn't gain a single penny from the massive rally to $70 because the upside was capped. It generates $1,100 in profit. But your short stock position, you shorted 1,000 shares at $56 and you have to buy them back at $70. You are taking a naked, unhedged dollar-for-dollar loss of $14 per share.
That is a $14,000 loss on the short stock, offset by only $1,100 in profit from the spread. I just incinerated $12,900.
By shorting stock against a capped spread, you introduced infinite naked upside risk into a trade that was previously mathematically safe. Took a guaranteed, stress-free win, tried to get clever to save a few dollars on the bid-ask spread, and triggered a massive margin call that could liquidate your entire portfolio. Never short stock against a spread unless you fully understand dynamic delta hedging.
Consider the lesson learned. The cheat code is a trap. Since the short stock trick is suicide for a spread, how do we actually escape the market maker's grip and get our money?
There are 3 highly practical structural maneuvers you can execute to escape the trap. Maneuver number 1 is the psychological game of chicken known as the step-by-step limit, or walking down.
How exactly does that play out on the screen?
You actively refuse to accept the market maker's extortionate $7 bid. The theoretical mathematical maximum is $11. So you enter a limit order to sell to close the entire spread at $10.50. And then you wait.
You're waiting for the market maker's algorithm to decide if it wants the trade.
Exactly. The algorithms are constantly scanning the order book for arbitrage opportunities. If 10 minutes go by and you don't get a fill, you cancel the order and replace it at $10.20. You wait again. Then you drop it to $9.80. You are slowly, methodically walking your asking price down into the liquidity zone.
At what point does the robot usually blink?
Usually right around the $9.50 or $9.80 mark, you cross a mathematical threshold within the market maker's pricing model. The algorithm instantly calculates that by buying your spread at $9.50 and holding it to expiration, it can lock in a guaranteed risk-free arbitrage profit of $1.50. The moment that math clicks, the algorithm will instantly execute your order. Yes, you effectively paid a $1.15 tip to the market maker, but you successfully extracted the vast majority of your profit immediately, freeing up your capital for the next trade.
That is the pragmatic, workmanlike approach. What is maneuver number 2?
Legging out. This is a high-risk, high-reward tactical maneuver. Instead of trying to force the market maker to swallow the entire complex spread as a single package, you deconstruct it. First, you place an independent order to buy to close your $55 short call,
And because the stock is currently trading right at 56 bucks, that $55 strike is right at the money.
which means it has massive volume, deep liquidity, and penny-tight bid-ask spreads. You can buy back that short leg quickly and fairly.
And the second I buy back that short call, the handcuffs come off.
Precisely. Your upside is no longer capped. You are now holding just the naked $44 long call, which is deeply in the money and massively profitable. You can then sell that long call independently or even exercise it to take delivery of the stock. But there's a massive catch: execution risk. In the 45 seconds it takes you to manually buy the short leg and then sell the long leg, the stock price could violently tick down. Because you unhedged yourself, you're exposed to sudden directional risk. Legging out requires speed and precision.
And what if I don't want to play games with algorithms or risk slippage? What is the third maneuver?
The Zen approach: holding to expiration. If your trading account has sufficient capital margins and you don't need that specific capital for another trade immediately, you do absolutely nothing. You close your laptop and wait for expiration Friday. Or, alternatively, you roll the spread up to, say, $56, $62 to extract some cash while staying in the trade.
But if I hold it to expiration, I basically bypass the market makers entirely and deal directly with the clearinghouse.
Exactly. After the market closes on expiration Friday, the Options Clearing Corporation will automatically process the math. They will automatically exercise your $44 long call, buying the shares, and they will automatically assign your $55 short call, selling the shares. The two actions perfectly net each other out. On Monday morning, you will wake up with exactly $1,100 per spread deposited in cash into your account, with zero spread slippage.
Now, there is a fascinating detail in the HPE case study that I want to explore. During this violent run-up from $44 to $56, the trader noted that if you looked at the options chain, there were literally no call options available to buy with the strike price higher than $66. The chain just hit a brick wall and stopped. If a stock is rocketing higher, why wouldn't the exchange just instantly list $78, $80, or $90 calls to meet the retail demand?
It exposes a mechanical lag in how the exchanges operate. The options exchanges base their available strike brackets on the historical volatility of the underlying stock. Prior to this AI server boom, HPE was a slow-moving legacy hardware stock that traded in a very tight, boring range. The exchange's mathematical risk models simply did not foresee a statistical scenario where the stock could gap up 30% in 48 hours. When it did, the system broke. By rule, it takes the exchange clearinghouses several days of sustained trading at new highs to legally approve, generate, and list new, higher strike brackets.
But think about the market makers in that scenario. Doesn't the absence of higher strikes create a terrifying structural dynamic for the people selling the options?
It creates one of the most violent mechanics in modern finance, the gamma squeeze. Put yourself in the shoes of a market maker. Retail traders and institutional momentum funds are relentlessly buying every single $66 call you have in inventory. You are legally obligated to sell them.
So the market maker is now massively short the $66 calls. If the stock goes above 66 sexerts, their losses are theoretically infinite.
Exactly. They have massive negative gamma exposure. Normally, a market maker would hedge that terrifying risk by simply going slightly higher up the options chain and buying $70 or $75 calls to create a roof over their position, capping their potential losses.
But the exchange hasn't printed the $70 calls yet. The roof doesn't exist.
They are completely naked to the upside. So what is their only available survival mechanism? To hedge their massive negative delta from the short calls, the algorithms are forced to go into the lit equity market and buy millions of shares of the underlying HPE stock. And here's the brutal feedback loop. The more calls retail buys, the more stock the market makers are forced to buy to hedge. Their forced buying pushes the stock price even higher, which brings the calls deeper into the money, which creates more negative delta, forcing them to buy even more stock. It is a self-fulfilling algorithmic panic buying loop that fuels the rally to astronomical heights.
That is wild. The mechanical structure of the market itself becomes the primary driver of the price action, completely divorced from the company's actual earnings. Now, all of this maneuvering, managing the liquidity hole, understanding the gamma squeeze, waiting for the clearinghouse, it all hinges heavily on the clock. which brings up a massive counterintuitive rule about days to expiration, or DTE.
This is perhaps the most vital paradigm shift for a developing options trader. If you read basic retail options tutorials, the conventional wisdom is almost universally, buy 45 to 60 days to expiration. Give yourself plenty of time to be right.
Which makes intuitive sense. Time decay theta is an option buyer's worst enemy. If I buy an option that expires in 5 days, the contract loses massive value every single hour just from the clock ticking, even if the stock doesn't move. If I buy an option with 60 days, that daily theta bleed is a tiny trickle. So 60 days feels inherently safer.
And that logic is 100% mathematically sound if you are buying a naked call. When you hold a naked option, you are absorbing the full brunt of the theta decay, so you need a long DTE to survive the wait. But if you are constructing a spread, buying one call and selling another, and your specific predictive model is forecasting a massive immediate earnings gap up, the professional quantitative rule is the exact opposite.
Okay, wait. The professional rule is long DTE for naked calls, short DTE, meaning options that expire in just 1 or 2 weeks for spreads. Why would I intentionally choose a shorter expiration and invite that massive time decay? Doesn't that drastically increase my risk?
Not within the structure of a spread, because the spread neutralizes the Greeks. When you buy a call, you have negative theta. Time hurts you. But when you simultaneously sell a call to complete the spread, you generate positive theta. Time helps you on that short leg, because the option you sold is decaying, making it cheaper for you to buy back. The negative theta of a long leg and the positive theta of the short leg largely cancel each other out. You have neutralized your time decay.
Okay, I understand that the time decay is neutralized, but why does that make a short 1-week DTE an active weapon for an earnings play?
Think back to the HPE liquidity trap. Why was that trader's money held hostage by the market maker? Because they used a 45 DTE spread. The stock gapped up past their short strike instantly, but because there were still 40 days left on the clock, the $55 call they sold still held massive amounts of extrinsic hope value. The market maker demanded a premium to close it.
Right. For the spread to reach its absolute maximum value of $11, the extrinsic time value on that short leg has to evaporate to 0.
Precisely. If you use a 45 DTE spread and the stock gaps up on day 2, your capital is trapped for weeks waiting for that short leg to slowly bleed out its time value.
Yeah.
But if you construct that exact same trade using a 1-week short DTE spread, the time value is decaying exponentially fast right out of the gate. The rapid, steep theta decay curve on your short leg works for you. Within 48 hours of the gap up, the time value collapses, accelerating the total value of your spread toward its maximum theoretical profit almost immediately. You capture the full $11 and you exit the trade within days, freeing your capital.
I have to challenge this because it sounds too perfect. If short DTE accelerates the profit that quickly, there has to be a structural catch. What happens if the 5-factor model gets it wrong? What if the earnings are just okay and the stock stays totally flat?
This is the brutal reality of the options market. There are no free lunches. The catch is binary risk. If you deploy a short 1-week DTE spread and the earnings report fails to violently push the stock past your strikes, you are in immense immediate danger. Because you don't have enough time for the stock to slowly grind higher, the negative theta on your long leg accelerates rapidly. Since the stock didn't move enough to generate real intrinsic value to protect you, your entire spread dies a very rapid total death. You will lose 100% of your invested premium within days.
So a short DTE spread is essentially a sniper rifle.
Exactly. It is a highly tactical, all-or-nothing weapon. You only deploy it when your 5-factor model is screaming that a violent, immediate repricing is guaranteed. If your model indicates a slightly weaker signal, if you think the stock will just slowly, methodically drift upwards over a few weeks following the earnings, then you revert to the long DTE spread. The long DTE is the safer, high win rate wholesale approach. You give the stock room to breathe and time to slowly grind past your strikes.
Speaking of that slow drift, let's map out exactly how long this post-earnings magic lasts and when to definitively pack up and go home. Let's talk about riding the PED wave.
PED is post-earnings announcement drift. It's one of the most thoroughly documented anomalies in financial academia. The efficient market hypothesis dictates that all new information should be priced into a stock instantly. But human behavior and institutional constraints prevent that. PED has a highly predictable life cycle that typically lasts between 1 to 2 months, roughly 20 to 40 trading days. After that window closes, the statistical edge evaporates entirely.
The quantitative models break this drift down into 3 distinct phases. Let's walk through the psychology and the price action of each phase. Phase 1 is days 1 through 5 following the earnings print.
This is the golden entry period, characterized by extreme volatility and structural chaos. Retail traders are reacting emotionally to the CNBC headlines, either panic selling or FOMO buying. But beneath the surface noise, the institutional quantitative funds are aggressively front-running the revised analyst models. The price swings wildly, but the massive institutional volume is busy establishing the foundation of the new upward trend.
And once the chaos subsides, we enter phase 2.
Phase 2 covers days 6 through 30. This is the sweet spot, the steady, methodical climb. By this point, the major Wall Street banks have formally published their upgraded price targets. Now, the true behemoths of the market, the massive mutual funds and state pension funds, begin to accumulate the stock. But because a pension fund might need to buy $1 billion worth of shares, they cannot buy it all at once without causing massive slippage and spiking the price against themselves.
So they use time-weighted average price algorithms.
Exactly. Their algos buy a small, calculated batch of shares every hour, every day, over a 3-week period. This relentless algorithmic accumulation creates a smooth, steady upward drift that absorbs any retail selling. This is the most profitable and reliable phase to hold those long DTE spreads.
But eventually, the buying pressure runs out, leading to phase 3.
Phase 3 is days 30 to 45. This is the exhaustion phase. By day 35, every major fund that wanted to adjust their portfolio based on the good earnings news has already completed their buying program. The new valuation reality is fully priced in. The upward momentum stalls, the stock begins to trade sideways, and it becomes highly vulnerable to broader macroeconomic shifts or sector-wide pullbacks.
So the hard mechanical rule for traders is never initiate a brand new PA trade after 3 weeks post-earnings. If you miss the first 15 trading days, you miss the boat. Do not chase the ghost of the earnings report. But how do we know exactly when to exit a trade we are currently writing? Target exits around day 30 to 40, sure. But crucially, you have to watch the volume and the candlesticks. What are the specific visual tells?
Our data outlines 3 specific visual tells that scream at you to take your profits and run. The first is the long upper shadow, which retail traders often call a shooting star.
Visually, what does that look like?
Visually, this happens when a stock pushes to a massive new high intraday. But by the time the market closes at 4:00 p.m., the price has been violently rejected and pushed all the way back down near the open. It leaves a candle with a very long wick on top. Psychologically, this means retail momentum traders were aggressively buying the breakout all morning, but institutional sellers drew a line in the sand. The institutions used that retail buying pressure as exit liquidity, actively dumping massive blocks of shares into the rally until it collapsed. It is a clear sign that the smart money believes the run is over.
The second tell is the high-volume red candle.
This is much more blatant. After weeks of steady, low-volume climbing, the stock suddenly closes significantly lower than it opened, and the trading volume for that day is 2 or 3 times the recent average. Institutions are no longer hiding their intent. They are openly and aggressively liquidating their positions to lock in profits, overwhelming any remaining buyers.
And the third signal is the high-volume doji.
A doji is a candlestick where the opening price and the closing price are virtually identical, creating a shape like a cross or a plus sign. By itself, it just means a decision. But if a doji occurs on massive triple average volume after a 3-week bull run, it is a glaring warning sign. It signifies total exhaustion. The buyers and sellers fought a brutal, high-volume trench war all day long, and neither side gained an inch. The relentless upward momentum of Phase 2 has officially stalled out. When you see any of these 3 patterns accompanied by massive volume after day 20, the drift is dead. Close your options and secure your capital.
No, I want to clarify a vital piece of context here. If I'm trading the immediate aftermath of earnings, and I see a massive long upper shadow or a red candle on day 2, do I panic and liquidate my position?
Absolutely not. Context and timeline are everything. In Phase 1, the first 5 days, massive, violent volatility is completely normal. A sharp red candle on day 2 is frequently just institutions taking a breath or deliberately allowing the price to drop to shake out weak, highly leveraged retail hands before the steady climb of Phase 2 begins. You only respect these candlestick exit signals when they appear after a prolonged multi-week run is stretched to the valuation.
Okay, so let's take a step back and look at the fortress we've built. We have the 5-factor quant model to predict the gap-ups. We utilize spread structures to mathematically neutralize IV crush and time decay. We know exactly how to manage short versus long DTE, and we have visual tape reading rules to know precisely when to exit the PE lifecycle. We have a complete end-to-end institutional trading system. But there is one final structural pillar we must address. Because you can possess the great and predictive model on Earth, but if you fail to manage your portfolio construction, a single bad earnings report will permanently end your trading career.
This is the quiet reality that separates professional traders from gambling addicts. Risk management. The five-factor model is incredibly robust, but it is fundamentally built on probabilities. It might boast a 70% or 80% historical win rate, but that mathematically guarantees that 20% to 30% of the time, even if every single micro and macro signal is flawless, an unforeseen black swan, a sudden CEO resignation, a supply chain disaster, a hidden accounting scandal, will cause the stock to unexpectedly crash. If you allocate your entire account to one perfect setup, you are playing Russian roulette with your financial future.
So how do quantitative desks mathematically approach capital allocation? Applying the five-factor model requires spreading bets, right? You cannot go all in on one stock.
They utilize what we call the mini hedge fund approach. Rule number one, you dedicate a strict maximum of 20% to 30% of your total liquid trading portfolio to these high volatility earnings plays. The core of your wealth should be in stable long-term assets. Do not risk your entire net worth on binary events.
And within that dedicated 30% carve-out, how do we divide the capital?
You must fragment the risk. You allocate a maximum of 10% to 15% of that sub-portfolio to any single stock ticker. In practice, this means during a busy earnings season, you should be running 6 to 8 completely independent setups simultaneously.
Okay, 6 to 8 names. But here is where retail traders often fall into a massive trap. They think they are being responsible, but they are engaging in fake diversification. Walk me through why that destroys accounts.
Fake diversification is the illusion of safety. A trader will say, I'm practicing perfect risk management. I've split my capital evenly across 5 different stocks: Dell, Supermicro Computer, Hewlett-Packard Enterprise, AMD, and Micron.
But every single one of those is an AI, hardware, semiconductor, or server infrastructure stock.
Exactly. Their correlation matrix is essentially 1.0. They move as a single organism. If NVIDIA announces a 3-month delay in shipping their next-generation chip architecture, the entire AI hardware sector will violently crash simultaneously. The trader isn't diversified at all. They just bought 5 different tickets for the exact same voyage on the Titanic. Real institutional diversification requires mixing your sector exposures.
So I have my one AI hardware stock, but then I need to find a pure SaaS cloud software setup and a semiconductor capital equipment stock, and maybe a cybersecurity stock, and a legacy financial payment processor.
Precisely. If the hardware sector takes a sudden macroeconomic hit, your SaaS and cybersecurity plays are structurally insulated and can continue to thrive, smoothing out your portfolio's equity curve.
And this is where the structural brilliance of using spreads comes full circle. Spreads aren't just a defensive tactic to limit risk on one specific trade. They are the fundamental financial catalyst that actually allows a retail trader to diversify in the first place on a limited budget.
This is a profound realization for smaller accounts. Capital efficiency. Let's say you are trading with a smaller sub-portfolio, maybe $5,000 allocated for earnings season. If you attempt to buy naked call options on high-flying tech darlings, a single naked at-the-money Dell call might cost you $2,000 or $2,500 in premium. You buy 2 of those contracts and your entire account is maxed out. You are 100% exposed to the fate of a single company.
But if I deploy a defined risk call spread?
Because you are actively selling a leg to finance the purchase of the long leg, that exact same directional bet on Dell might only cost $400 in capital. Now, with your $5,000 account, you have the purchasing power to place $400 bets across 8 completely different, uncorrelated companies. You strictly cap your maximum loss per trade to a fraction of your account, and you unlock the statistical power of the law of large numbers. If your 5-factor model legitimately has a 70% win rate across 8 uncorrelated stocks, the math guarantees that the winners will vastly outpace the inevitable 1 or 2 black swans. You let the statistical edge grind out the profit over time, rather than praying for a single lucky strike.
It is the ultimate psychological shift. It's the difference between walking into a casino and putting your entire net worth on black versus literally owning the casino, capping the table limits, and letting the mathematical edge generate wealth over thousands of hands.
That shift from directional gambling to structural probability management is the only way to survive the options market long term.
Well, we have covered an immense amount of ground in this deep dive. We started by confronting the painful reality of the gambling mindset, buying naked out-of-the-money calls, hoping for 30% miracles, and watching our accounts get completely vaporized by ID crush when a stock like Pan W delivers a seemingly perfect report that the institutional market decides to punish anyway due to SPC dilution and valuation gravity.
And we transition from that chaos into a disciplined institutional framework. We broke down the five-factor P8 model, learning to ignore backward-looking beats and instead demand forward guidance raises, high standardized unanticipated earnings to force analyst upgrades, institutional ask-side sweeps to track smart money, violent IV right skew, and genuine open market insider buying.
We learned how to construct call spreads to build a mathematical fortress against volatility collapses, and we explored the nightmare of deep ITM liquidity traps. We learned why using short stock to delta hedge a capped spread is a recipe for infinite risk, and how to execute the step-by-step limit walkdown to extract our capital from predatory market makers.
We counterintuitively learned why short DTE is a weapon for neutralizing Greeks and spreads, while long DTE is a necessity for surviving the theta bleed of naked calls. And finally, we mapped the 30 to 45-day life cycle of post-earnings announcement drift, the visual candlestick cues of institutional exhaustion, and how to use the capital efficiency of spreads to build a genuinely diversified, uncorrelated portfolio.
It is a complete paradigm shift in how to view the market. But before we wrap up, I want to ask you for one final thought. Something provocative for the listener to mull over as they look at their options chains tomorrow morning.
I want you to think back to that mechanical detail about the HPE options chain during the gamma squeeze. The trader noticed there were literally no strike prices available above $66. The exchange simply hadn't printed them yet. When you are analyzing a chart and you see an options chain lacking higher strikes during a massive, violent run-up, I want you to realize you aren't just fighting abstract math on a screen. You are watching a structural failure. You are watching market makers, some of the most sophisticated, heavily funded algorithmic entities on Earth, getting caught completely off guard. They are trapped. Because they have no overhead calls to buy to hedge their risk, they are being violently forced to panic buy the underlying stock just to survive the squeeze.
They become forced buyers.
Exactly. The market is not a casino filled with random, independent events. It is a highly constrained ecosystem of forced actions, margin requirements, and structural vulnerabilities. The price doesn't move just because people think the company is good. It moves because massive entities are mechanically forced to buy or sell to manage their risk. Learn to read those footprints. Learn to read those actions. Once you understand the hidden mechanics of the trap, you stop being the prey.
You stop being the prey. Because at the end of the day, when you are looking at your portfolio, the diagnostic machine isn't broken. You just have to know how to read the shadows on the film. You have to recognize that a surface-level perfect earnings report might be hiding massive structural dilution underneath. Or, conversely, that a terrifying plunge in a stock's price might just be institutions shaking out weak hands before a massive month-long algorithmic accumulation phase. It is all hidden in the mechanics.
And now you possess the manual to read them.
Let's get out there and read some order flow. Thanks for joining us on this deep dive.